Hello and welcome to another episode of Core Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at two highly ranked tech stocks that are pioneers of their respective fields to consider buying at the moment, and that is Uber and Spotify. But before we get everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look into some of our portfolios, services, and more. So before we jump into Uber and Spotify, I quickly just want to run over where the market stands and maybe kind of just take a broader picture to have investors not so worried about maybe buying into the current kind of volatility and the downturn. So the NASDAQ did sink midweek, ending that recent rally, at least for now. The tech-heavy index slipped right back beneath that 21-day moving average and that longer-term 50-week moving average. Wall Street was hoping for some positive updates on the tariff front. Instead, the bears kind of jumped back in after Trump said that he's planning to roll out 25% tariffs on imported vehicles. It kind of seems that the market is just basing all of their movement recently on tariff headlines, so that could kind of continue to be the name of the game for a while. By the time you're possibly listening to this maybe you're listening to this on Friday, I'm recording this Thursday afternoon, the Fed's preferred inflation gauge will have been released, that PCE data. That's expected to come in roughly the same as January. So unless it comes in ultra hot or ultra cool, it's unlikely to move the market. So in the near term, it's likely that those tariff headlines continue to move the market. There's possibly more market kind of choppiness until April 2nd, which is when the Trump administration is set to unveil its next round of tariff updates. So it's possible the kind of market sits on its hands until then. That said, it's really hard to call exactly what's going to happen in the near term, and the market volatility and constant headlines are likely leaving many people just looking for calm and a comeback. But it's also worth remembering that downturns are a necessary part of the market. Big pullback was due. Stocks just got way too overheated after the post-Trump election rally, which is also off of a massive rally off those 2022 lows. And we also are coming up against right now almost the 5-year bottom of the rapid COVID market sell-off. So if we look back to the beginning of 2020, the NASDAQ's up about if we look back to the beginning of 2020, the NASDAQ's up roughly 95%, and this includes the lightning quick COVID bear market and then the prolonged 2022 bear market. So two big bear markets are baked into that cake over the last 5+ years, and yet the NASDAQ's still up 95%. So the moral of the story is it's really hard to do the market timing game, and it's best if you're a long-term investor to kind of buy into weakness on strong stocks. As Peter Lynch, a famous investor, once said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than's been lost in the corrections themselves. So if you're kind of staying on the sidelines and just waiting to call the exact bottom, that's nearly impossible to do in real time. So it's time to start looking at strong stocks, and if they go down a little bit more, maybe buy some more, if maybe you can dollar cost average into stocks. But the moral of the story is, despite kind of the near term volatility and all of the negativity at the market at the moment, we're still up big over the last 5 years, and still up. Stocks like Nvidia are up 1,600% roughly still over the last 5 years. So even though there's choppiness and some near term like doom and gloom on a lot of these big stellar stocks, no need to get too worried, especially if you're a long-term investor. So with that in mind, we're diving into the first of these two pioneers, and that is Uber Technologies, which trades on the ticker Uber, which is UBER. The stock is up roughly 24% in 2025, so that's obviously blowing away the market and tech sector, which is actually down 8%. It's also outpaced tech over the last 2 years. Uber posted its first full year profit as a public company back in 2023 by expanding its ride-hailing and delivery businesses while streamlining its operations. It followed that up with another blockbuster year of earnings growth in 2024. So let's dive into why you might want to consider buying Uber and holding it for the long term. As I alluded to, Uber spent the last several years cutting jobs and streamlining its operation, pivoting towards profitable expansion at every turn. The company's strength is its core mobility and delivery segments, which are offsetting struggles in its much smaller freight unit. Uber's results over the last several years highlighted that people are fully back into taking all of their services, and despite being able to go anywhere they want, they had that big COVID boom of delivery. While that hurt their ride-hailing business, both of those businesses are thriving more than ever. So it's not that now that people can go out and live their normal lives and they haven't thought about COVID in years, it's not like their delivery business is hurting. Their delivery business is thriving. So both of those core businesses are doing really well. And those businesses do skew towards higher income customers who are less impacted by lingering inflation and various economic cycles, which is a good sign for Uber's business long term, that it's not going to be impacted by every time there's a little bit of economic uncertainty that people just stop taking Ubers or stop having their food delivered. So that's a really great sign overall. Uber's growth is impressive, and it's continuing to churn out as I said, earnings growth, which is a good sign. And it's also expanding various markets. It's expanding its delivery in Asia through a key acquisition. It's also rolling out new partnerships. So in just March alone, in terms of their delivery partnerships, they're partnering with Petco. They're partnering with Fresh Direct to offer same-day delivery for grocery. And this is just partnerships they've announced in the last several weeks, just to boost that food delivery business, which is thriving. I'm not a big user of it, but I know some people who get Uber Eats all the time, and it's insanely popular. Uber is also poised to play a really significant role in the driverless vehicle revolution across delivery, ride hailing, and then even freighting and trucking, which is big. So they've made multi-year strategic partnerships with EV maker BYD. They've also expanded a multi-year strategic partnership with Waymo to bring autonomous ride-hailing to Austin and Atlanta. This has just been made. This is the last 6+ months. They've also made 5 new autonomous partnerships for mobility and delivery with companies called Cruise, Coco, WeRide, and various others. And then just in January, it announced a joint initiative with NVIDIA to accelerate development of AI-powered autonomous driving technology. So they're going to be at the forefront of this at some point. Who knows exactly when all of this is going to be taking place, but it's good to know that Uber's looking ahead to a world where there could possibly be just a bunch of driverless cars and delivering food and taking people everywhere and delivering freights on the highway and all of that. So that's where their business is at the moment. So let's kind of look into some of the numbers. So if we look at the revenue, the company posted 18% revenue growth in 2024. This followed 17% growth in 2023, which followed back-to-back years of huge growth. So it did 57% revenue growth in 2021 and then 83% revenue growth in 2022. So if we look, it did roughly $44 billion in sales in 2024. And if you look back to the pre-COVID period of 2019, it did just $13 billion. So it's really transformed a completely different company in a whole new stratosphere, given the strong footing for, as I said, that ride hailing. So essentially the taxi service, on-demand taxi service, and that Uber Eats business. Its gross bookings jumped by 18% in 2024, roughly matching 2023's expansion. And then its monthly active platform consumers jumped 14% to 171 million in 2024. And as I mentioned up top, it's posted massive earnings growth, and this is after it did its first full year profitability in 2023. It posted $4.56 a share in GAAP earnings versus just 87 cents per share in 2023. It is worth noting that a big chunk of 2024's earnings growth was attributable to non-recurring items for the company. Some of it was investments. So that's worth noting that this massive jump from 87 cents per share in 2023 to $4.56 per share was not all just related to its business. So looking ahead, if we look into Q1 of 2025, its gross bookings are expected to jump 17 to 21%. That's what the company offered its guidance last quarter, and its adjusted EBITDA is expected to jump between 30 and 37% in terms of growth. And if we look in 2024, the company's adjusted EBITDA jumped 60%, which is a little bit more, makes more sense instead of that massive growth on the earnings front. that was attributed to some things that are not part of its core business. So if we look ahead to our actual estimates, we're calling for 15% revenue growth in 2025 and another 15% growth in 2026. So this consistent double-digit growth after what's been a stellar ride. So expected to get up to nearly $60 billion in revenue in 2026. And then on the earnings front, as I mentioned, we're going to, since some of that big jump wasn't attributed to something that it can have consistent growth, we're calling for a 44% decline on the earnings front, but Wall Street understands this, so it's going to pull in $2.54 per share projected this year, and then jump back to 40% growth in 2026 on the adjusted earnings front. And overall, its earnings revisions have trended higher in the last several months to help it land a Zacks rank number 2 strong, or Zacks rank number 2 buy. And then if we look specifically at Q1, its consensus estimates up 11% since it reported its Q4 results. And if we go to stock price movement, the stock is up roughly 80% since its IPO. This lags the tech sector, which is up around 133% since it went public back in 2019. But if we look over the last 2 years, the stock is up 150% to blow away tech, which is up around 60%. The stock is up 25% year to date, as I mentioned, yet it's still down roughly 8% from its highs and trading 21% below its average Zacks price target. It's currently trying to find some support right near its 50-day moving average and some of its pre-breakout levels from it had a big gap up after its fourth quarter report of last year. So that's the kind of a level it's holding now, and we just saw the 50-day moving average move above its 200-day moving average, which is that bullish golden cross that technical investors tend to look to as a sign of more good things to come. And then in terms of its valuation, as we mentioned, its earnings growth has been stellar, and it continues to focus on that bottom line. It's now trading at just 26.8 times forward 12-month earnings, which is relatively in line with tech, which is trading at roughly 24 times earnings. And Uber, in just the last several years, has traded as high as 672 times forward earnings. So it was just kind of off the Richter scale there in terms of its valuation. It's now trading roughly neck and neck with the broader tech sector. Overall, Wall Street's still really high in the stock. So 37 of the 49 brokerage recommendations we have are strong buys, with 3 more buys and the rest coming in at holds. It's also committed to returning more value to shareholders with a $7 billion share repurchase plan. So overall, it's certainly worth considering buying Uber for its core businesses and its efforts to possibly lead or play a major role in a driverless future across robo-taxis, food delivery, and then freight as well. So we're putting Uber on your radar at the moment. And now we're going to transition to another pioneer of an industry that's not going to go out of style anytime soon, and that is Spotify technology, which trades the ticker SPOT. So Spotify was one of the pioneers of paid streaming music. The company kind of forever altered the music industry in the same way that Netflix changed TV and movies. And like Netflix, Spotify's success has inspired big challenges from the biggest tech companies in the world, including Apple, Amazon, and Alphabet via its YouTube division. So despite competition from all those giants, Spotify reportedly is holding roughly 32% of the global streaming music market in 2024, blowing away all of its peers, with Apple Music roughly coming in at second place at 15%. So it's still the king of streaming music. It's thriving as users flock to its service for music, podcasts, and now Spotify's rolling out a pretty big audiobook division that you get some of it for free, and then they're also charging people up for that. So that could be another growth avenue, and we'll touch on a little bit more of its growth plans in 2025 and beyond in a second. So it grew its monthly active users by 95% between 2020 and 2024. And in 2024, it grew it by 12% year over year. So it got up to 675 million monthly active users. And then its premium subscribers, which are like a big part of its revenue and earnings growth, jumped 11% to 263 million users. Looking ahead, we're calling for roughly 10% user growth in 2025 to get up to roughly 740 1.3 million, with paid users up 10% as well. So that's a great sign. And then if you look at some industry reports, these are obviously bullish investors on Spotify, but some reports suggest it could get up to 900 million in total monthly active users by 2028, which would be another big jump from here. Its streaming service has also been able to grow while raising prices. It had kind of not raised its prices a little bit, and then in the summer of 2023, it hiked its prices for its premium subscription to match competitors like Apple and Amazon. And then in summer of 2024, it did the same thing. So back-to-back years, it hiked its prices and didn't impact it didn't have a bunch of users leave. So it shows that people are willing, like once they have Spotify, it's kind of part of their daily, monthly routine, they're willing to keep paying for it. And so that helped to keep pace with inflation and boost profits. So that was a really great sign for the company. And then obviously the last several years have forced everyone, including Uber and Amazon and obviously Spotify, to focus heavily on efficiency and the bottom line to, as I said, grow its earnings and not just focus on top line expansion over everything else. So if we look in terms of revenue growth, the company did 18% revenue growth in 2024 after 16% growth in 2023 and just 8% growth in 2022, which was coming against a really impressive 27% growth in 2021. And it reported its first full year profit, which was more important than anything else. So the company did, in terms of GAAP earnings, it did $5.95 per share versus a loss of $2.96 per share in 2023. So prices increases and cost discipline kind of helped it pivot towards this, what looks like it's going to be sustained bottom line growth. The company's CEO, Daniel Ek, said in an interview, I thought it was funny, he said it only took us 18 years to get here, but we're here, in terms of when he was referring to profitability. And he said going forward, they're aiming to pick up the pace of new initiatives and ship new products faster. He said music and offerings like higher price premium tier, including a hi-fi streaming and remix tools, could be a focus into 2025 and beyond. So looking ahead, we're calling for another 11% revenue growth this year and then 15% growth next year to get all the way up to roughly $22 billion on the top line. And on the bottom line, we're calling for the company to add or grow its earnings by 72% on top of that massive growth it did in 2024. To get all the way up to $10.23 per share, and then another 28% earnings growth next year. And since its Q4 release, its earnings estimates have trended heavily in the right direction. Its 2025 estimates up 17%, with 2026 up 12%. This helps in land a Zacks rank number 2 buy, and this is part of a earnings trend that's gone pretty much straight up since the start of 2023, which is a great sign, and why the stock has gone in a very nice upward trajectory since, or the beginning of 2023, I should say. So the earnings estimates have gone straight up since the beginning of 2023. I think I said the end of 2023 originally. So overall, since the company went public, its stock is up roughly 300%, 295% to be exact. This blows away the tech sector, which is up around 160% during that stretch. And this includes a massive plummet and then a huge run off the market and its own late 2022 low. So the company is up roughly, over the last 2 years alone, it's up 350% versus tech's 60% run. It's currently trying to find some support at its 50-day moving average, trading at roughly neutral RSI levels, so it's not overheated at the moment at all. It's still trading 9% below its highs. It's still a little pricey. It's trading at 53 times forward earnings, which is over double the tech sector. That said, it's traded as high as 180 times earnings in the last several years. And if we look at its PEG ratio, which factors in its earnings growth outlook as well, it's trading at just 0.7 times, so 0.7 times forward, or with a PEG ratio. That is marking a massive discount to tech, which is trading at 1.5 times. So overall, it might be time to look at Spotify. It's forever shaped the music industry, just like Netflix changed Hollywood. So it's worth putting it on your radar. And despite all of the negative headlines and the worry that the market could head lower, both Uber and Spotify are certainly worth putting on your watch list and maybe kind of dipping your toes in. And if there's more volatility and selling in the near term, maybe buying a little bit more. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.